Welcome to another episode of the Tax Smart Daily, a daily vlog for real estate investors to learn about tax savings and hopefully keep you out of trouble. I'm Brandon Hall, managing a national firm dedicated to servicing real estate investors. I'm also outside watering my grass, so I figured I'd kill two birds with one stone, so I apologize if there's any background noise. Before we get started, check out the links in the description of this video to join the Tax Smart Facebook group and the Tax Smart newsletter. And also, if anything that I say resonates with you or if you have any questions, feel free to leave a comment, timestamp it. I really appreciate the comments. I love interacting with the community. It's my oxygen, so please do that. Today's topic is Section 121. What is Section 121? It's the home sale exclusion. So if you have a primary residence and you sell it, you can exclude up to $250,000 of gain if you're single and $500,000 of gain if you're married filing joint. Now, how do you get that? Well, there's an ownership test and there's a use test. So you have to own and use the property for 2 years. So you can only take the Section 121 exclusion one time every 2 years. So you can't take it multiple times in a 2-year period. And to add on to that, you have to own and use the property for 2 of the past 5 years. So let's say that I moved out of my primary residence and that I had used it, I had owned it and used it for 2 years. I move out and I want to rent it for 3 years and then sell it. I can rent it for 3 years, I can sell it, and when I do a 5-year look back, I would have owned the property for 2 out of the past 5 years. So I could still qualify for the full Section 121 exclusion. I can't exclude depreciation recapture, but I can exclude any capital gain from appreciation. So it's a really powerful tool, especially if you are like house hacking and you're fixing something up, live in the property for 2 years, then rent it out for 3 and you're good to go. Now, what happens if you have to move due to like unforeseen circumstances or a change in employment? Well, good news is that you can claim a partial exclusion. There are some pretty strict rules and regulations around when you can qualify as a partial exclusion. So if you just moved into a primary residence and all of a sudden had a change of employment or some sort of unforeseen circumstance, you might not be out of luck. You might still be able to claim a partial exclusion even though you haven't owned and used the property for 2 years. And circling back to that rental piece, so if you rent a property, if I buy a property and then I rent it out, and then I later move into it and I occupy it, you're going to have non-qualified use before you occupy the property. So if I rent the property for 3 years and then I move into it and I occupy it for 2 years, when I do that 5-year look back, I'm still gonna be able to say I owned and used it for 2 of the past 5 years. However, the rental period before I moved into the rental property is considered non-qualified use, and effectively that means that I have to prorate that Section 121 exclusion that I'm allowed to take between the non-qualified use, the 3 years, and the 2 years of qualified use, the 2 years that I was actually in the property. This is a very powerful tool for house hackers, for people that are buying a property that needs to be fixed up, living in it for a couple years, and then they either want to rent it out or sell it. I highly recommend that you educate yourself on Section 121, ask questions, because it's definitely a good tool for real estate investors to add wealth through real estate appreciation. You don't have to pay tax on it. Thanks for joining me on today's episode of Tax Smart Daily. Again, be sure to check out the links in the description of this video to join all of our communities online and follow us everywhere on social media. We appreciate you being part of our community.